All right, everyone, welcome. Today, we are going to unpack a term you'll see all over the world of corporate finance, structured debt. Now, I know it sounds a little intimidating, but I promise you by the end of our discussion, you're not just going to know what it is, you'll understand why it is such a critical tool for businesses and why you absolutely need to grasp this concept for your careers. So let's start here. Imagine you're looking at a financial report and you see the term structured debt. What should pop into your head? Well, debt. That part's easy, right? It's just money that's owed. But what about that word structured? What is that really telling us? It's a huge clue that we're not talking about just any old loan. We're talking about something that's been carefully designed, almost engineered, for a very specific reason. Okay, here it is, the formal textbook definition. Let's read it together. Structured debt involves complex financial instruments that are used to manage a company's debt portfolio. It goes on to give some examples, which we'll get to. But wow, that first sentence is a mouthful, isn't it? Complex financial instruments, debt portfolio. We can't just memorize this. We need to really understand it. So that's our mission today, to take this dense definition and pull it apart, piece by piece.
Right. So what does that actually mean in plain English? The key to tackling any of these big financial concepts is just to break them down into their fundamental parts. And this definition really has two main components. There's the what, and then there's the why. First, let's tackle the what. Complex financial instruments. Look, we are not talking about your standard business loan from a bank. Think of a simple loan as a hammer. It's a basic, really useful tool that gets one job done. A structured debt instrument, on the other hand, is more like a custom-built, high-precision robotic arm on a factory assembly line. It's been engineered from the ground up to perform a very specific, very precise task. And that complexity, it isn't just for show. It's what gives the instrument its power. And that leads us perfectly into the why, to manage a company's debt portfolio. Why would a company go through all this trouble to create something so complex? Well, think about a huge multinational corporation. They don't have just one loan. They might have bonds they've issued in US dollars, other loans in euros, maybe lines of credit in Japanese yen. All of that together is their debt portfolio. Structured debt gives them the sophisticated tools they need to actively manage the risks across that entire portfolio. Risks like sudden changes in currency exchange rates or interest rates going through the roof. So, what do these specially designed tools actually look like? When a chief financial officer decides to structure their company's debt, what's actually in their toolbox? Our source material gives us 3 fantastic examples to look at. So the definition points to these 3 big categories. We've got debt with adjustable interest rates, we have bonds with what are called embedded options, and then we have securitized debt. Each of these is a different way to add that structure to a normal financial obligation. Let's dive into each one. First up, debt with adjustable interest rates. Now, here's a common mistake I see students make. They hear adjustable and they immediately think unpredictable or risky. But the whole point of the structure is to manage that risk. A company might tie its interest rate to a benchmark, maybe because they think market rates are going to fall. But what if they're wrong? Well, that's where the structure comes in. They can build in what's called a cap on the loan, meaning the rate can't go above, let's say, 5%. That protects them. On the flip side, the lender might insist on a floor, so the rate can't fall below 2%, which guarantees them a minimum return. You see, that cap and that floor, that is the structure. It creates predictability out of variability. Next, bonds with embedded options. Oh, this is where it gets really powerful from a decision-making standpoint. So let's say a company issues a $100 million 10-year bond, and the interest rate is 6%. Okay, simple math. That's a $6 million interest payment every single year. Now, imagine 3 years later, market interest rates have dropped to 3%. If it's a standard bond, too bad. They're stuck paying that higher rate for 7 more years. But if it's a callable bond, which has an embedded option to pay it back early, they can call back the bond, pay it off, and then issue a brand new one at the lower 3% rate. That cuts their interest payment in half, from $6 million to $3 million a year. Think about that. A $3 million annual savings, all because they built in that one strategic option from the very beginning. That's what we mean by strategic control. And finally, securitized debt. You've probably heard of this one. This is when you take a bunch of illiquid assets, things you can't easily sell, like thousands of individual car loans or mortgages. You pull them all together into one big pot, and then you sell shares of that pool to investors. It's an incredibly powerful way for a company to get cash off its balance sheet and transfer risk to someone else. But, and this is a huge but, this is the very type of instrument that was at the absolute heart of the 2008 financial crisis. When those underlying mortgages started to default, the securities that were backed by them became worthless almost overnight.
It caused a massive chain reaction that nearly brought down the entire global financial system. It's a very sober reminder that these complex tools demand incredibly sophisticated risk management. Okay, so we've looked at the definition, we've examined the specific tools in the toolbox. Now, let's step back and put all the pieces together to really see the big picture. The logic really flows pretty simply once you see it laid out. Step 1, a company has a whole collection of different liabilities, not just one single loan. Step 2, to handle all the risks and opportunities in that portfolio, it uses these engineered, specialized financial instruments we've been talking about. And step 3, what you get at the end is no longer just passive borrowing. It's an active, managed, and truly structured approach to handling your company's debt. This comparison here makes the difference crystal clear. Simple debt, it's a straightforward loan. It's a one-to-one agreement for a fixed purpose. Structured debt, on the other hand, is about managing an entire portfolio. It uses complex instruments, not simple agreements, and its whole purpose, its reason for being, isn't just to get cash. It's to achieve strategic control. As future business leaders, being able to tell the difference is absolutely paramount. So here it is, the main takeaway for today. When you see the word complex in finance, don't let it scare you. Your first question, your immediate instinct, should always be, okay, why? What purpose does this complexity serve? In the world of structured debt, the complexity is the entire point. It's the very thing that provides the flexibility, the risk management, and the strategic control that a modern corporation needs to survive. It literally turns a liability into a dynamic financial tool. And I want to leave you with this final thought to chew on. We've seen that this incredible complexity offers an incredible amount of control. But at what cost? We saw the devastating cost in 2008 when people misunderstood these complex instruments. We saw the systemic risk they can create. As you all move forward into your careers, this will be your challenge, learning how to harness the immense power of these tools while never, ever losing sight of the very real risks they carry.